Hey guys, it's Downtown Josh Brown. I'm here with Michael Batnick. We're going to play our favorite game, What Are Your Thoughts? And we want you to play along with us in the comments below. Let's have some fun. Let's get into the biggest topics on Wall Street. Here we go. All right, so...
Hold on.
What?
So I wasn't going to wear this hat. I bought this sort of as a joke just to support the guy who makes this, Dolan J. Trump on Twitter. He's hilarious.
That's his?
Yeah.
Okay.
How do you wear hats like this? This feels like a top hat. I feel like a cartoon character. Like I never planned on wearing this ever, but I saw that you were wearing one and I thought, why not?
That's why you threw it on.
It feels like a top hat. All right, let's go.
All right. I want to ask you about the vaccine, but very specifically, isn't it weird that the reaction to the vaccine played out exactly like everyone would have scripted it? Like the minute Pfizer released that information and the press ran with it, exactly what you would have guessed happened.
Yes.
So
let's go ahead.
Well, no. So this is another situation this year where like first level thinking is all you really need. There was no reason to do second level. So first level thinking is all of the work from home stocks are going to get whacked, and all of the hotels, casinos, travel stocks are going to go crazy.
Right.
That's literally exactly what happened. Everybody would have guessed it, and it played out that way. The second level thinker would have been like, yeah, but everyone thinks the hotels are going to go up, therefore they'll probably go down. No. They went 30%.
It wasn't just an unwind of the stay-at-home open up trade, but what was interesting to me was like, for example, Clorox. Did you see Clorox?
No, what did it do?
Demolished,
Yeah,
absolutely demolished, and housing stocks.
Yep.
In other words, this demographic wave that we've seen of home buying, millennials buying homes, like that's just going to reverse. That seemed like an interesting knee-jerk reaction. So home builders got wrecked. Not just home builders, Home Depot and Lowe's demolished. Like hit really hard. So obviously the DocuSign Zooms of the world got crushed, but it wasn't just them. It was it was just one big trade yesterday.
All right, but let me throw this at you. I don't think Clorox and Home Depot got sold because people think a vaccine is bad for them. I think they got sold because the universe of things that are investable now gets bigger and they become a source of funds. People have
That's
huge
fourth level
gains.
thinking. That's fourth level thinking. I think first level
Ninth
is right
level.
here.
I'm almost on the 10th level. No, but people are in these stocks for the whole year. They have massive gains. Now they see a chance to buy Las Vegas Sands or Wynn or whatever, and they're just like, yeah, I'll take it out of the Clorox.
All right, fine, but
Pros
Clorox got killed because of the vaccine, plain and simple.
Yeah, I'm ready to fade that whole shit. I'm ready to go the other way. I feel like
and buy Clorox.
Yeah, people are going to stop cleaning because there's a vaccine. I don't think so. All right, what do you got?
All right, I want to talk to you about the stock market's reaction to the election. This was kind of interesting that futures were going up as the results were coming in, and they really never came down. They came down, they came down at like midnight to 2 a.m., but if you missed that, and so if you went to bed, you saw the futures up, you woke up, you saw the futures were up just the same, even as the results were changing.
You're talking about Tuesday night, though.
I'm talking about Tuesday night.
The result. All right, I'm going to tell you that I don't really think that was a typical election night for the simple reason that the states that mattered were not counted yet. So, everyone knew what the battleground states would be, and none of them were in the books.
Don't you think that makes the reaction even more peculiar? That there was zero clarity, there was still just as much uncertainty as there was on Monday night, and yet the market was up, what was it, up 4%?
Maybe because what was being priced in by the futures traders was another Trump shocker. And it wasn't, and it really wasn't a Trump shocker. Like, in other words, if he had a huge showing in competitive states or states that they thought were competitive, then that would have given them a clue, and then he didn't. So everyone said, oh, yeah, it's what we thought it was. I don't know.
Really?
Who's in the futures market on a presidential election?
All right, forget about futures market. Let's just talk about the actual market, the S&P 500 the next day. Why was it up as much as it was? I'm not asking you for an answer. I think it's rhetorical. Nobody knows.
Well, I said this on the podcast.
Stocks had their best day ever post-election after a contested election. Why?
So I said this on the podcast. I think it's because nothing burned to the ground, went on fire. There weren't any armed insurgencies at the polls. So I think there was like some sense that, oh, it's actually just an election.
Yeah, but I don't buy that. That would be a good explanation if stocks were, say, flat or down 50 basis points or up a little bit. They were up a lot.
Because they went down 7% the week before, or in the they got killed, and this was an exhale. And then here's the other thing. Let's say you're a billionaire and you went to sleep Tuesday night and you're not political. You're like, whatever. I don't give a shit. I'm a billionaire no matter who wins the election. Let's say like a regular billionaire.
Every billionaire is political.
Okay, every billionaire you've heard of. Let me help you with that. I know billionaires who you've never heard of who are not political. They may give money, but you won't see their faces on TV begging for some policy or other. If you're a billionaire or work with billionaires or whatever, extremely rich, you went to sleep Tuesday night, you woke up Wednesday morning and you said, wait a minute, I keep all the Trump policies, but the fucking psycho is out of the White House? This is the greatest thing I've ever heard. So that's extremely bullish for people who are already wealthy and now they don't have to live with Trump in their lives every day, but they keep their tax rate.
This is billionaires' cash on the sidelines coming back in. I don't buy that for a second. Next.
All right. I want to ask you about earnings. So lost in all of this vaccine and election outcome is the fact that earnings expectations and earnings season going extremely well. So I just want to throw some numbers at you and get your reaction, because I feel like they're a better explanation for the market at a new high than the politics. And I know. By the way,
if you're coming in late, I'm wearing this hat as a joke.
All right, here's what I want to do. Year over year earnings growth forecasts for 2020 are still down substantially since March, but improving since July, as companies easily beat consensus Q2 and Q3 forecasts. The Q3 U.S. stocks destroyed expectations, by the way. So here are the latest consensus earnings growth rates for 2020 and 2021. They think large caps will finish this year with earnings down 16.5%, but then grow 23.5% next year. Mid caps down 25% this year, plus 43% year over year in 2021. And small cap, minus 44% earnings this year, but plus 90% next year. You don't need a vaccine. That's a better explanation for why stocks should keep working than any other that I've heard. Where am I wrong?
What if expectations don't materialize?
Well, they probably won't. They're always too high. But even if they're too high, we're talking about small caps having a 90% rebound in earnings next year.
So that would basically bring them back to even for most of these groups.
Large caps will be ahead.
Well, forget about expectations for next year.
Yeah.
Because expectations or reality for this year, for the third quarter, came in better than expected. And maybe that's what actually matters.
It matters big time. So not only was Q2 not as bad as feared, Q3 was great. If I would have told you the Q3 numbers in May, you would have bought them all. You would have bought everything.
So maybe this market rebound is more reflecting reality than anything else,
dude.
If these companies missed expectations bigly, then maybe the market would have not done as well.
Fine, but
almost certainly would not have.
Fine, but the truth is, the S&P 500 components almost never, as a group, miss expectations. It's usually 68 to 75% beat rate. Because
I'm saying if that did not transpire, things would not have gone as well.
Would have been much worse. But it's not just technology beats. You look at the numbers coming out of like Ford and GM. These are companies with exciting earnings, and it's been a long time since we've seen that. All right, what do you got?
I want to talk about there is reason to be optimistic. Like, obviously, the news yesterday with Pfizer was fantastic.
Don't you know about the national debt?
True. True.
All right, but you're optimistic. Go on.
But we still have to get through the winter.
Yeah.
And we have a lame duck president now, and this could be a long, dark winter. But I'm trying to be optimistic. Is there a silver lining that, like, it's already November 10th? Is it possible that this winter flies by and blink your eyes and it's February and we're looking forward to the spring?
Yeah, I think you have it backwards. I think we built up this long dark winter in our minds so much because we're so terrified of the infection rate that I actually think there's a very good chance that we get through this winter with a way less severe flu season than we normally have. Everyone's on their best behavior, or at least everyone in normal places is on their best behavior. People are not sneezing and coughing in each other's eyes. People are not sending their kids to school if they don't feel well. People are not going to work if they don't feel well. So I actually think we're going to be healthier as a population this winter than we've been my entire adult life. And it's not great economically for a lot of businesses, and it still won't be. It's going to be tough for restaurants that got by with outdoor eating. That's going to suck that's going away, especially in places where they shut down indoor dining because of flare-ups. But generally speaking, I think people are being healthy. They're being safe. They're taking precautions. I think we'll have a healthy population. I can't predict anything about coronavirus. I predict it's going to suck. But we're in a situation where you're more likely to be infected if you're a young person, not an old person, which means the death rate should stay low.
So it sounds like you're cautiously optimistic.
No, I'm extremely optimistic. And I haven't been in a long time. And I think this time next year, dude, we're at concerts at Citi Field. We're taking vacations. Like, I really think we'll have our lives back within 12 months. So that's how I feel. And you could say, oh, you're dreaming, but all right, well, that's what I need to get through the day. So whatever. Here's what I want to ask you. This is crazy to me. I guess I just don't understand people. Professor Shiller at Yale has this thing called the United States Crash Confidence Index. Prior to last week, have you ever even heard of this?
I've never heard of it prior to just now.
So literally, Shiller's doing surveys all the time. He's asking people if they think there's going to be a stock market crash. And I think last week, the reading he got, and this is via JC Peretz, looking at the United States Crash Confidence Index, where fewer than 15% of respondents think no crash is going to happen last week. So in other words, almost 90% of respondents think, quote, a catastrophic stock market crash in the U.S. like that of October 29 or October 87 is probable in the next 6 months, including the case that a crash occurred in the other countries and spreads to the U.S., end quote. So 9 out of 10 investors expect 1929 in the next 6 months. Could it be that the people responding to that survey just read the question wrong? Or do you really think that's how people are feeling right now?
Well, that's possible, and it doesn't matter how they feel. I want to see what's in their portfolio. There's no way that 9 out of 10 investors are positioned for a market crash.
We know statistically that they are not. So
now that doesn't mean that there can't be signal in that data series. I'm not saying that there is or there isn't, but there's no way that 9 out of 10 investors are positioned for a market crash.
Well, I mean, JC went back and looked at prior periods where
what did he find?
Where people were expecting crashes.
I'm guessing crashes don't happen when people are expecting them. Is the point?
Well, people actually express typically more of a belief that a crash is coming after a crash has happened.
Yeah,
because of the recency bias. So it looks like February, March of 2009, the bottom of the great financial crash. That number was where it is today for the amount of people expecting a crash. So the stock market crashed by 50%, and it wasn't enough. They thought there would be another 1929 in at the bottom of the market. So and also in 2011. So I guess they're following news. That's what it is. So in 2011, we had the debt ceiling debate.
How could you not be following the news?
Right, but I'm saying that's where their feelings are coming from.
I got it. Okay.
Yeah. So right now, the news is just so ugly with sickness and death and political fighting that 90% of people think there's a 1987 coming. All right, you're up.
All right, let's talk about this stay-at-home unwind a little bit further. So yesterday, Zoom fell 17%, DocuSign fell 15%, Peloton got whacked. I mean, all these names got whacked. And then on the other side, you had Expedia, Marriott, all of these open. You know what? This is weird. Why did Amex go up 24%?
I don't know.
You ever see such a thing?
It doesn't make any sense.
So if you look at like the factors of what happened yesterday, it was absolutely
actually
bananas.
American Express. I'm wrong. It does make sense. A huge part of American Express's business is travel.
Yeah, that's true.
Yeah.
Okay. So Aaron Stanhope did this thing on factor returns. He said that the cheapest decile of value outperformed the most expensive by 11.5% yesterday, a spread that normally occurs over the course of the year. Momentum had a complete reversal.
Yeah.
Strong momentum underperformed weak momentum by 13%. So Corey Hofstein also did this thing where he broke it down by long cheap, short expensive, same thing as here, long high momentum, short low momentum, long low beta, short high beta, and all of these things. And it's the orange line. Yesterday was the orange line. What we're showing you on the screen was something that we have never seen. So yesterday was an insane day outside the market, and it was an absolutely insane day inside the market. Totally insane. Now the question is, was this a one-day reversal, or does this thing have legs? And obviously nobody knows, but I'm curious to hear your take.
How long does this counter trend have to remain in force before it's the primary trend? Like, when will all these value reopening ground zero stocks, when will they have rallied so much that they are now the momentum ETF holdings? It takes 9 months for that to happen. It's never going to happen.
Well, that's not true. That's not true.
You don't think
oh, okay.
Well, look, okay. I'm saying
it can happen because the composition of momentum funds is they're looking back either 6, 9, 12 months. These things could easily go into that group of names. So right now, if you look at like MTUM, for example, the iShares Momentum ETF, it's a lot of exactly what you would think it is.
Work from anywhere stocks. I know.
Those names are not permanent.
So now I would just say, if you're in the names that went crazy yesterday, like, I owned Simon Property. I pitched it on the show. Starbucks, etc. Are you a seller just because they had a huge day? I'm not.
So yeah? How about if you're a seller before the pop? I sold Win on Friday. I swear to God.
Somebody should take your brokerage firm password away from you.
I'm having a great 2020, my brokerage firm.
All right.
Actually, it's my Roth IRA.
I'm just teasing. All right, we're going to get into some viewer topics. So we ask you guys to send us emails. Let us know what topics you want us to cover. I think we have 2 this time, and Duncan's gonna let us know what they are. So what's the first one that we're doing?
Yeah, so hey guys, today the first question is from Evan. He asks, if you had to place a bet today, what do you think the new mega cap companies will be 10 years from now, or will FANGs just continue to dominate the landscape?
If I had to place a bet, well, that's a great question. I'm pretty sure they'll be consumer discretionary or technology or healthcare, just because I feel like those are 3 industries that have secular growth as far as the eye can see and are not reliant on necessarily what the Fed does, what the economy does, what the labor force looks like. So that might just be availability bias because that's what I see happening in front of me. It's just hard for me to picture it being an oil stock or a bank stock. And I could be wrong. I can't see it. So I guess that's the best way I can answer the question. But nobody should rely on what I think 10 years from now, because I never would have predicted what we're living through 10 years prior to today. All right, what else do we got?
Phil writes in for you, Michael. With interest rates so low, is this the end of traditional portfolio construction? Is there something that replaces the role bonds have traditionally played in the past to mitigate risk while still adding yield to your portfolio?
You have 30 seconds to answer that. That's a good question.
Okay, so bonds used to do a few things for your portfolio. They would provide income, they would give you total return, and they would be the ballast for your portfolio, the anchor when you really needed it, when the stock market was going haywire. The first 2 are gone. They will no longer provide income, and you will no longer get an attractive total return. The question is, are the trade-offs from the first 2 enough to compensate for the third one, potentially them still being the ballast? I still think they will be, but this is more of a personal finance question to me than a portfolio construction question, because if you want to eliminate bonds from your portfolio, then the only alternative is to take more risk. That's it. The 10-year is under 1%, and there's nothing that you can do to change that. So if you want more return, you're going to need to take more risk. And if you're comfortable taking more risk, then by all means do it. But no, there is nothing that can replace bonds. That being said, there are a lot of neat, interesting products that are coming to the market in ETF wrappers that are trying to solve for this problem. So it's an interesting space that I'm excited to watch.
Yeah, I was going to say everybody's working on this problem. Everybody wants to come up with the answer to the fact that treasuries aren't going to help you, in terms of income, and if they still remain the risk-off vehicle, that's great. We don't know 100% for sure that they will. We think they will, but I think that's a really good question. If you guys want to throw your topics up to us to cover on the next episode of What Are Your Thoughts, the way to do that is send an email, askthecompound@gmail.com. And we get amazing topics from you guys, by the way. So thank you. Keep them coming. Let us know your thoughts on all the topics we discussed today. Hit us below in the comments section. We always get a big kick out of your feedback. And we love the fact that you guys are playing along with us. Go ahead and subscribe to the channel if you haven't already. Hit that like button for me. Means a lot. Hit that alert bell. We want to make sure you're getting these episodes as soon as they come out. And we will see you next week with another edition of What Are Your Thoughts?